homes section for 8 years. And now I'm a freelance writer. I'm still one of the Star's main real estate writers. I've also written real estate for the Globe and Mail. I'm a regular contributor to Ontario Home Builder, Toronto Stories, and many other publications and websites. I would like to introduce you to our panel. We have Steve Garganis, editor and founder of Canada Mortgage News. That's a site that provides the latest insider information on mortgage news. And Steve's experience includes 15 years in senior management positions at Canada's largest banks and more than 15 years as a mortgage broker. Next, we have Ted Tsiakopoulos, senior economist at CMHC. Ted's a professional economist and a sought-after speaker with more than 25 years experience analyzing housing and financial markets. He also worked as a Bay Street investment counselor, and he's a sought-after source for many media outlets. And one of his personal projects and interests is financial literacy research and education. And our final panelist is Jenelle Cameron of Remax Hallmark. Jenelle is a GTA realtor who has been one of the top performing realtors in the GTA for numerous years. She's been helping clients buy and sell for more than 15 years, and her expertise covers all aspects of the markets: condos, freehold homes, commercial and investment properties. She also coaches other real estate agents across North America on how to achieve success in their respective markets. Okay, so are we ready to dig in, panelists?
Sure.
Anyway, I think the question that's foremost on most people's minds right now is, why is the market so hot given what's going on with the pandemic and our uncertain unemployment situation? Who'd like to begin? Ted, why don't you start us off?
Okay, well, thank you, Tracy. You know, I don't think we're seeing broad-based strength across the housing market. It's really a tale of two markets. Low-rise housing is clearly outperforming, a lot warmer. High-rise, a bit cooler. And there's good reason for this. If you look at what economic sectors the pandemic has hit the hardest, it's your labor-intensive, lower income, client-facing jobs, things like food, accommodation, tourism sector, the retail sector. Typically, renter households are employed in those sectors, and so it's not surprising that the rental market has been impacted. But some of those households that are employed in those sectors are obviously looking to enter the home ownership market as well. And so, demand for condos has been impacted as well. On the flip side, of course, professional services, jobs that require less labor, more capital intensive, financial services, your mid to higher income jobs, not as impacted. These are typically people who are in the market for second, third, fourth time buying a more expensive home, a low-rise home. So that would explain why the low-rise sector has been doing a bit better than average. So, clearly there is a difference depending on the sector of the housing market you are looking at. And that's the economy. If you throw in the demographics, of course, people want more space, and it's not the pandemic that's caused that. A lot of the millennials in the last 5 to 10 years have been aging, so they've been shifting into that 35 to 44-year-old category, and females are moving into high fertility years where they're having kids. That's where fertility rates are actually peaking, and so that need for space is not just a COVID-19 phenomenon. It's been a phenomenon for a few years. And of course, the technology aspect, right? People are now able to telework. And so being close to downtown isn't as important. Again, being in suburban parts of the GTA and doing your job in suburban communities, if you can do it, you're doing it, and you're buying a low-rise home, a more affordable home.
Steve, is that what you believe as well? What are you seeing?
Well, it's an interesting market. We're certainly seeing a hot market. It's I I don't know what is causing it, except maybe perhaps the interest rates are definitely a contributing factor. Um, Listen, this is emergency money. Rates are crazy low right now. We've never seen this before. This is all new territory. Um, it's going to be interesting to see, how this is going to play out. I keep hearing about, well, I'm sure we're reading, everybody's seeing the pessimists saying that next year, there's a bubble, right? The housing bubble. When's that going to happen? I don't know if next year's it's going to be if it's going to burst or not. I think the government's made it clear they're going to support this economy for years to come. They're going to do whatever it takes to keep it going, and I think that's helped to drive the consumer confidence up, even in COVID. So I can't explain it.
Jenelle, how about you? You're dealing directly with buyers and sellers, and what's the word from the streets, so to speak?
Yeah, I think, from my perspective, it's really just comes down to the basic old supply and demand, right? We don't have a lot of inventory. We never have a lot of inventory, and the demand is still there. I mean, whether we're in a pandemic or not, for whatever reason it is, if it's because people want to leave the city, move to the city, there's 100 different things we could speculate, but at the end of the day, we have demand, we don't have enough supply, and so it still drives the market forward.
Now, Ted touched on the low rise versus high rise. Are you finding that the condo market is softening a little bit while low rise is red hot?
Yeah, I think where I've seen it personally is in the smaller condo right downtown markets. So I'm talking the, under 600 square foot kind of dime a dozen type condos where there's just a lot of inventory out there right now. And I think, a lot of those were used for rentals or Airbnbs, which is now not happening. So a lot of those are investments, not end user units. So that's where I've seen a lot of inventory, and that's slowed down a little bit, absolutely. And maybe the condo market overall. But yeah, in the obviously the low rise, the freehold market is still very active, especially in the GTA, especially Durham region, for example, which is a market that's never generally on fire, but is all of a sudden for the first time ever, really. So yeah, I think it just really depends, and these things, excuse me, change and ebb and flow as they always do. So right now, it'll be interesting. I'm curious to see how the next few months will play out for sure.
Okay, and one thing I should mention to the others that are listening into this today is if you have a question, at the end of the session, you can use the chat button to relay your questions, and our panelists will attempt to answer them. Okay, we've talked about the neighborhoods, the housing types. The investor market is so important to Toronto and in some other parts of the GTA. What's happening there, Ted? Is it still active, and what's this going to do to the rental market?
So really, vacancy rates matter for investors, rents matter for investors. And, we're currently compiling a lot of the data on the rental market. Our CMHC rental market survey will be out early next year, but we are compiling the data. We don't have the data in-house yet, but we do have some data external, which suggests that vacancy rates have moved north of 2.5%, right? So they've jumped for both purpose-built rental and condo rentals. And we've seen some softening in rents. And so those are two big whammies for investors, right? Particularly investors that rely on cash flow, or investors who were in a negative cash flow position who were relying on capital appreciation for their overall return. I just want to dispel a big myth out there, and that is investors haven't started exiting this market in the second quarter following the pandemic. Investors have been gradually exiting this market as early as, I would say, 2018. And so I think that COVID has actually amplified that exit. It has increased it, accelerated it. And, you know, as I said earlier, high density is being impacted most by the pandemic, whether it's immigration, which is down, which is affecting rental demand. Perhaps some low-income households are not shifting into rental for reasons I explained earlier. And on the supply side, of course, I think Jenelle mentioned this, you know, Airbnb units have been moving out of short-term rental into long-term rental, increasing supply. We've got more condos hitting registration. 50% of those have been bought by investors 3-4 years ago. So the demand supply ratio is now benefiting tenants, no question about it. It is a tenant market, and I think investors are responding to that.
Steve, what are you finding with the people you're advising? Is there still investor interest in the market, or are you noticed that that's decreased?
Yeah, so investors are still buying, as far as I can see. I'm definitely getting inquiries. People are interested. And I think, again, low rates are a big factor. When you have interest rates at 2% or below 2%, it's free money for all intents purposes. And this is helping the affordability and helping people to go out and buy something to rent out. Now, to Ted's point about the vacancies, yes, this is a concern, but Toronto isn't Canada. So you go outside of Toronto, and I think Jenelle can touch upon this as well a little bit, and you can get some really good returns. And what we're also seeing, and maybe we'll get into this a little bit later, is the cottage market. You go outside a couple of hours from Toronto and try and buy a cottage. We've probably heard and seen the lunacy that's going on. Places selling for 100, 200,000 above asking, as we're all trying to get away, I guess, for a vacation or just to get away from the density of the city. Very strange, but definitely there's investors out there. I'm getting calls, and we are arranging mortgages for people that are looking to buy investment properties.
Jenelle, what are you finding? Do you still have a lot of investor buyers among your clientele?
I do. I've done, several, I'd say, in the last couple of months. That would have happened anyway. I don't think there's necessarily been as a result of anything, even interest rates, that it just helps. But I think these people were already planning to do that this year. So I wouldn't say I've seen any decrease, that's for sure. I think it's pretty status quo.
How about, have there been investors that have been wanting to sell their properties, whether it's due to lower vacancy rates or new Airbnb rules that make it a little tougher to get that rental income?
For me, yeah, I've had a few clients and talked to many people who, especially in the very beginning, were having tenant trouble. Tenants weren't paying. They didn't know what to do. They maybe had lost their jobs or were laid off. And so they started to panic and decided to sell. So I have seen a little bit of that, not as much as I anticipated, thankfully. But yeah, definitely there's been a little bit for sure.
Steve, this is probably a question for you, but is real estate still a really good overall investment? Because obviously the stock market's quite volatile, interest rates are low. Do people still see real estate as a safe place for their investment?
Yeah, this is a very popular question that comes up often. So I'm going to say something that I've repeated dozens and dozens of times. If you're buying a property, a real estate for an investment, or if you're buying it just to live in, which really is an investment in itself, you need to plan to hold this for 7 years. Why 7 years? Because 7 years is a long enough time to go through any up and down economic cycle. it's also enough time to amortize any acquisition and disposal costs. Yes, if we've seen and heard the quick flips, well, in the past, buy, fix, sell in 1 or 2 years, that's great, but that's TV show stuff. The reality is you should be planning, holding. It's not exciting, it's going to go up in value, but it's going to take time. So yeah, I think definitely it's still a good investment. I am getting people calling me with those comments about, we want to get off the roller coaster stock market ride. We've had enough. We want to get into real estate for the long term. So as I said earlier, it's, who would have thought with the pandemic that it would be like this, but it's happening.
One trend that we've been hearing about is more people leaving the 416 and moving to the 905. Jenelle mentioned Durham region is a very hot market. And I've also heard Barrie's a hot spot, Collingwood. What are some of the other places they're going to, Ted, and why? You kind of touched on this earlier about this exodus isn't something that's just started now. It's been happening for a couple of years. But are there, there's some areas more than others they're going to, and why, I guess you did touch on this a little bit, but why now?
Well, for sure, this is another, I want to dispel another myth, and that is this outflow didn't begin in the second quarter of this year. Typically, when Toronto becomes less affordable, we track affordability metrics here relative to other neighboring metro areas. First-time prospective buyers looking for more affordable housing will shift out of Toronto to places like, I agree with Jenelle, Durham is a hot spot. Hamilton is a real hot spot in recent years. Barrie, Kitchener-Waterloo. And it's all about affordability. But, this year, it's not just about affordability anymore. It's about space. And people are really looking at the trade-off between accessibility and affordability. And to be quite frank, since the new millennium, the year 2000, it was all about accessibility. In some ways, demand started to shift back into core urban areas. Condo demand took off. But with this pandemic, people are questioning whether that makes sense. Technology is allowing people now to buy, outside of Toronto. They don't need to be in the core. There's businesses have shut down. Those amenities, the value of those amenities has kind of fallen now. So the trade-off is now favoring affordability more than accessibility. There was a beautiful paper released just a few days ago by the Federal Reserve Board in the US, looking at the mobility of households in and out of the core. And what they found was that even with the economy recovering and with the economy having been unlocked in the third quarter, there was clearly very, very little, if any, recovery in the downtown cores of US cities. Most of the recovery was really in suburban communities. So anyways, a number of things going on here.
Jenelle, what are you hearing from your clients that are selling in 416 and wanting to move elsewhere? Are they telling you why they want to do this, and where do they want to go?
And I agree with Ted to some degree, because this is happening for the last maybe like year and a half for me. I have had a lot of people move out of the city and into various regions throughout Halton, up north, all kinds of different places. And I think, affordability, lifestyle, I think is a big one for people. And then now with this whole, COVID situation, I mean, I don't know about all of you, but I've found, for me, really, it kind of puts your whole life in perspective, right? Like, what do I need now? Where do I want to be? What makes sense for me financially, long term? So I think a lot of people are probably having those questions, and as a result have decided to move forward and think about alternatives to their lifestyle, right? Maybe that small condo downtown close to the office doesn't make sense anymore. I do wonder how short-term thinking that is, though, because this can't, I hope, cannot last forever. So, you know, when businesses reopen and we start living again, will those people be able to afford to get back into Toronto if they want to? Or is this a trend that will continue? I mean, it's really fascinating. We'll just have to see what happens.
It is very fascinating. We touched on the cottage country market too, and how on fire it is. Are you finding that a lot of people are looking for vacation homes, not just places to relocate permanently?
Yeah, absolutely. There's a lot, even people I know personally have tried to purchase cottages this year. And again, I find the whole thing so interesting, because I think, again, very short term sort of thinking, right? I mean, I hope they wanted a cottage before, because they'll be able to travel again at some point. And so a lot of people who are anti-cottage were sort of, you know, pro more traveling. So it's just such an interesting time. But I absolutely have seen that. A lot of people I know have been trying to buy things and just can't get anything up there.
Steve, what are you finding? Do you have people that are taking the plunge and buying in cottage country?
They're trying to. I've had a lot of people. Look, I have one client. He's a friend. This is a great story. He contacted me about 2, maybe 3 months ago, and he wanted to buy a place. I'll get to the punchline. He hasn't found anything, but he's put in a number of offers. And he, at one point, one of his offers, I was laughing at him a little bit. I hope he's not watching here today. I won't mention his name, but sight unseen, it came out, and within an hour, he put an offer, and there was 10 offers by the end of the day. I forget the exact numbers, so forgive me, but it was around 700 listing. He had bid 800 and change, just over 800, and it sold for well above that. This is on Lake Erie. He wanted something out that way, out right on the water. He threw his hands up. He said, "I've had enough." So it's crazy right now, and here's another additional point. So I have some American friends outside of the big city, you know, big towns and vacation areas. So again, more land, smaller communities. They are experiencing the exact same thing. Anywhere that's away from a metropolis, 1 or 2 hours, the markets are on fire. They've never seen it like that, as busy as it is now.
What are people telling you about their desire to buy a cottage? They've probably never owned one before, or maybe never even cottage. Like, what's driving them? Is it they want to be where there's less population because of the pandemic? Is it a knee-jerk reaction? Is it, Jenelle mentioned we can't travel right now, so we could go to the lake. What are their motivations?
I think that's exactly it. That's a big part of it. A knee-jerk reaction. Some of it, though, is just longer term planning. They're saying, hey, we're going to buy this place, keep it in the family for, 5 years, 10 years, whatever, or at least that's the plan. You never know if it's the first time that they've ever owned one, or, looked into making an investment in a cottage. It's not the same. Cabin fever may set in at some point with these purchases. So we may see a glut of properties come on the market in the future. So interesting times. I don't know where it's going to go, but I think this buying frenzy away from the city is going to continue for a little while longer.
Ted, do you have any research into vacation properties or second homes?
I think Steve and Jenelle have covered most of the key points. I mean, demographics, aging boomers was really the big story, driving demand for cottages a few years back, but now obviously COVID-19 has kicked in. I'm not going to hang my hat on this notion that it's a knee-jerk reaction, because it's a very expensive knee-jerk reaction. I'm going to give people the benefit of the doubt that they've done some thinking and some planning and behind these purchases, and that, you know, they're seeing some things that are likely going to persist into the future. So I'm of the camp that I think we are seeing some behavioral changes that are going to stick, that are going to persist. And, you know, I didn't touch on this earlier, but, you know, we're in this digital industrial revolution right now. It's the fourth industrial revolution, and it's going to change a lot of things, the way we work, the way we play, the way where we decide to locate. And, you know, these aren't temporary things I'm talking about here. These are structural, longer term shifts. So anyways, it's going to be interesting to see how this all sort of plays out.
Affordability is always a big factor in the market, still is. Prices are going through the roof again. What are some of the factors impacting affordability? Steve?
Sure. So I guess if you have a job, life is good. If you don't, or if you've been affected by the layoffs or let go, life is not so good. Some of the things that have impacted qualifying, I guess, today in getting a mortgage. I mean, look, the low rates have helped us to qualify. That part is helping our affordability, but the lenders are a little more diligent when it comes to making sure that you can pay the mortgage. So they're checking your income much closer to the closing date. You know, 3-4 months out, you can't just give a job letter and a pay stub. A lot of lenders are saying, no, we want to see a pay stub 2 weeks prior to closing. And if you can't produce one, you could have a problem. Now, for self-employed individuals, this is a whole different story. If you're running a business and your revenue has been affected, you're in trouble. So I have some clients that have established businesses, one in particular, 17 years comes to mind, and he came to me for a mortgage. Good cash position, lots of net worth. However, the last 6 months, he hasn't been open. He's been getting government subsidies, so he's fine. You know, he can make things work. He wanted to refinance so he could take advantage and purchase some equipment that was really inexpensive for his business. It made sense. Can't get him the money. Can't get him the money because he's not showing any revenues. So we forget about all his historical earnings, which in the old days, so pre-COVID, would have been satisfactory. Just give me your last 2 years tax returns, last 2 years notice of assessments, and you're fine. I couldn't help this client. So things are a little bit different today when it comes to qualifying.
Jenelle, do you know roughly what the average price of condos and detached homes are in the Toronto area right now, or the 416 versus the 905?
Yeah, absolutely. The average price last month for a detached in the city was just over 1.6. And in the 905, it was 1.1 something, which was pretty big increase. That saw the biggest increase last month over last year. Condos, we were just shy of 700 in the city. Now, you know, again, it's always hard to compare apples to apples because we're looking at all, you know, the 905 or the 416 is such a large area to kind of decipher the average price of a condo. But yeah, that's pretty much where we're at.
Wow. So Ted, those are still very high numbers. How can people afford houses?
So we have a very ambitious goal as a corporation that by 2030, we want all Canadians to be living in a home that's not just affordable, but that meets their needs. So is suitable, space-wise, you know, repair-wise, all those factors. we've done a lot of work on affordability, and in recent years, what we found is that house prices have really caused affordability to erode. Um, and so we tried to understand what is it that's been driving prices up. And 40% of the run up in house prices has been due to demand factors. You know, your traditional employment growth, interest rates, immigration. 60% was unexplained. And we spent a lot of time studying that 60%. And what we found was that supply is a real issue that's been contributing to lack of affordability. What do I mean by supply? What I mean here is, you know, it's taking a heck of a long time for developers' application to build something to get through the planning approval process. Too long. You know, and it's not just a Canadian issue; it's a global issue. And so that's a real problem, because what happens is when demand is growing and supply isn't, then that amplifies the move up in house prices and really puts downward pressure on affordability. It creates a real issue. But it's not just the planning approval process that needs to be expedited. And our premier is doing a fairly good job there. You know, we're trying to expedite supply. You know, it's also zoning and how we zone residential properties. Zoning is quite archaic in many parts of the world, including here in Toronto. We have a capacity to intensify in a number of neighborhoods across the GTA, what I call yellow belt neighborhoods, traditionally single family neighborhoods. We are nowhere near capacity there. But yet zoning has not changed dramatically. It's not fluid enough to allow for more mid and high density development. And then you throw in NIMBYism, which creates an even bigger issue. So we need to find a way to collaborate. The collaboration between developers, the city, communities is critical, and we need to work together, because we need to set the next generation up for success, and that's Gen Z. We need to all work together to set them up for success. And so, you know, those are really, you know, supply has been a real big thorn in terms in the affordability equation, and we need to resolve some of those issues.
Steve, are any of the people that you're dealing with, are they coming up with some creative solutions, how they can afford a house? Are they co-owning, for example, or are they looking for investment properties, maybe a house with a basement apartment, building a laneway house? What's been your experience?
Yeah, so of course, if you want to get in the housing market and you can't qualify with traditional means, you do have to look elsewhere. You know, there's the bank of mom and dad has come into play, by the way, quite a bit. That's something that we've probably heard about. And what I am seeing is, on that note, the parents coming to me to take out a line of credit, some sort of secondary financing on their properties to help their children, adult children, get into the housing market. I've seen quite a bit of that, in fact. So it's, again, to Ted's point and Jenelle's point, it's a bit unexplained. It hasn't stopped. The market hasn't slowed. We have a love affair with real estate, but I think that's not a bad thing. Owning a home is a good goal to have. There's nothing wrong with that. Basement apartments, yes, in fact, that's a big one, but that's not an old option. I think everybody did that. I did that. My first home, I rented my basement out so I could help pay the mortgage and make ends meet. And like anything else, you do that, you put up with it for 4 or 5 years, and hopefully you've built some equity, your income has gone up, and you move on, and you get on your own 2 feet on your own. And again, hopefully you pay off the mortgage and own your home. So there's a lot of options out there. There's also a secondary lender market that has really stepped in and helped people to get the home they want, and they've probably I guess I forgot the numbers now, but they've grown in the last 10, maybe 12 percent, something like that, of the market over the last 6 years. So yeah, there's a lot of options. So it hasn't slowed. It's definitely still possible to get into a home.
How do you help your clients get into homes, Jenelle? And where are they coming up with the down payment? Because even a $700,000 condo, 5% down, that's still a lot of cash for.
It is. Yeah, I think, it's hard. Not sure I have the answer for where they come up with the down payment. I'm not sure I always have that information. Steve would probably know that better than I would, but my advice to them and to everybody is always just buy something. Just get in so you can play the game. Because if you're not in this, the longer you wait, the harder it's going to be. And especially with rent being, now it's a little bit more affordable, but prior to this situation, if you're paying $3,000 a month to rent something, $36,000 a year in rent, and at the same time, that condo that you may have purchased has escalated 10%, you'll never save that much money. Mm-hmm. And so, I often say to people, just get something, right? It's not going to be your dream home. Buy something, make some money, build some equity, and then you can trade up over time. We all have to start somewhere. I think sometimes people think they're going to, I want 3 bedrooms, 2 bathrooms, and a 4-car parking in a garage, and but they only have 700,000. So, you have to take baby steps.
Yeah, I guess that's part of it, is managing people's expectations.
Mm-hmm. Yeah, because in Toronto in particular, and some other regions now, we have often only had access prior to recently to what a list price is. So now we've got, for the first time in the last few months, access to actual sales prices, right? The general public. But for the most part, people would say, well, it's $899. That seems reasonable, but they wouldn't know that it's sold then for 1.2 million. Mm-hmm. So that's been so hard for people to wrap their heads around as well. So just making sure they understand that the list price and the sale price are pretty much 2 different things 95% of the time here in the city. So, a lot of education is involved, and setting expectations is really important.
On the issue, I was just going to jump just on the issue of the down payment. We do have some data that suggests that about 1/3 of mortgages had some form of family assistance tied to it, either with the down payment or income support, co-signing. So that's what we have found. So about 1/3 of mortgages out there have some type of family support. But in the past couple of years with stress testing, and we're going to get into that in a moment, households have been able to take more time, defer that home buying and build some savings as well. And, savings rates in the second quarter of this year weren't just being pushed up because of COVID. COVID was a real big reason for sure, but I would say a percentage of that increase was also households having, spent a little more time saving up in the last couple of years because they were priced out due to stress testing as well. So that's never a bad thing.
Now, how low can interest rates go? I think they're almost at the bottom now. Is this going to continue, Steve? Do you see them staying low long term?
It's always hard to forecast interest rates, except now. The Bank of Canada governor has come out and said in no uncertain terms, the rates are going to stay low like this for at least 3 years, or at least until we see some significant upswing in the market, or inflation is what he said exactly. I think, and Ted can perhaps comment on this as well. I think they're going to be like this for 5 years or longer, these rates. So I don't think rates going up not for a while. Not unless there's some miracle vaccine cure and everybody's confidence goes up. And if the stats are wrong, whereby even if we find a vaccine tomorrow, that 35% of people will not take it, which is kind of interesting to me, but they are out there. That's the numbers. And so I think these rates will be low for a very long time. And I've never said that before. I'm always careful to forecast rates for that long. It's easy to make 3 or 6 month forecasts, but yeah, money's going to be cheap for the next little while.
Do you agree, Ted?
Yeah, no question. I'm not going to object with Steve. I may object with him in the next couple of questions, but not on this one. You know, the pandemic has hit the economy very, very seriously. You know, our potential rate of growth, the economy's capacity to grow, you know, is in and around 1.5 to 2%. I know they've pulled those numbers back this morning. Their estimates have come off a bit, but you know, when the economy is not growing anywhere near that, that creates slack, which is a fancy way of saying supply is growing, which puts downward pressure on inflation. Inflation readings running at, you know, 0.5% year over year, which now the threat of deflation is a bigger threat than inflation. So that means that interest rates are likely, I agree with Steve, are likely going to stay down for an extended period of time. And, you know, the Bank of Canada is now not targeting actual inflation any longer. In case some of you have missed this, it was a bit of a subtle point, but it's a fairly major implication. They are now targeting average inflation of 2%. So that means that they have an appetite to see inflation moving above 2%. And who knows when that will be? Could be 3 years, could be 4 years, could be 5 years. Nobody has a crystal ball, but rates are going to stay down for an extended period of time. And that means we need a second line of defense. And we'll get into the second line of defense as it pertains to debt in a moment.
Okay, so let's get into it right now. What is the second line of defense?
The second line of defense is the following. The data is clear. The facts are clear. The evidence is there. Since the early 1980s, we have seen savings rates trend down. We've also seen interest rates trend down. There is a strong correlation and causation there, which, you know, there's less of an incentive to save when interest rates are collapsing. And we can debate whether that's rational or irrational. I've had these debates in-house with colleagues, but that's a fact. Savings rates have dropped. Debt has gone the other way. That's not a coincidence either. So if the Bank of Canada is telling us that interest rates are going to stay down and could move lower, quite easily move lower, you know, we've got negative rates in some parts of the world. What does that do to that equation, savings, interest rates, and debt? It probably amplifies debt even more. And we know that anything that amplifies debt is not good for the economy, and it certainly isn't good for housing. For the economy, if you're allocating a higher percentage of your budget to just making your principal and interest payments, guess what? There's less money left over to spend on other goods and services. That's bad for the economy. We've already seen the effect on consumption in the last few years. It's been cut in half for that reason. Imagine what would happen if debt grows even further, right? That's the hit to the economy. Then there's a hit to housing. Our model suggests that you allow debt to move up. That creates less stability for house prices, and nobody has a vested interest in that. In fact, it increases the likelihood of a house price bust. That's what our models suggest. So there's a reason why stress testing came in. I hope we've learned from the experiences of the US back in 2000s, in the year 2000s, right? There's a reason why we're capping loan to value ratios. There's a reason why we're putting downward pressure on GDS, TDS ratios. There's a reason why we're increasing credit scores, okay? The evidence is there, and that's the second level of defense that needs to stay there. if we want to ensure that stability is maintained in housing and in the financial system.
Steve, you did cover this a bit previously about how it is tougher to qualify, but do the lower interest rates help people a little bit because they may not have qualified when interest rates were a little higher? There's tougher measures right now, but it's kind of counterbalanced by low interest rates. Are people still going to have difficulty qualifying, or does it make it easier now that we have such cheap money?
Well, the answer is there's two qualifying tests, unfortunately. So the government came out with a stress test, which I'm sure we've all heard this phrase. For those that aren't familiar with it, it means that you must qualify at a higher interest rate than your actual contract rate. So today, for example, if you get a mortgage at, let's say, 2%, and yes, there's lower rates, but let's just leave it at 2% for a moment, you still have to qualify at, I believe, 4.49%. That's lunacy, in my opinion. I mean, the government needs to come in and adjust that. They did this, by the way, the stress test, because they wanted to make sure that when or if they go up at renewal, that you're going to be able to afford the mortgage. I mean, the premise of it was sound. It's protection. Sure, I understand that. But of course, rates back then were, the qualifying rate was over 5%. And back then the rates were maybe 2.75, maybe 3%. It's a big buffer. It's too big, in my opinion. Rates have dropped significantly. We're at 2% or less. And the qualifying rate is still very, very high, too high, in my opinion. Ted might disagree with that, but it's at 4.49%. And we know that rates are going to stay low for a long time. I think they need to adjust this stress test to something a little bit more realistic. I've got other ideas about longer amortizations and stuff. We won't go there right now, but I think something has to be done, because it's, yes, to answer your question, it's allowing people to qualify for more money, a little bit easier, but not as much as you would think. Their payments are much lower, but the qualifying isn't as easier.
So time for a rebuttal. I warned Steve. Okay, so just sorry if I can interject. Just two comments here. I just want to clarify that when we talk about interest rates staying down, it's the overnight interest rate. It's the Bank of Canada interest rate. We said nothing about longer-term interest rates. If there is a financial crisis, and the World Bank and a number of economists are starting to talk about that, then you will see LIBOR rates jump. The rate at which banks charge one another for overnight borrowing and lending, that's going to jump. You will see a move up at the long end. Now, yes, the Bank of Canada is fine-tuning the yield curve as well. They're buying bonds, but I suspect they don't have enough firepower should those rates start to move up, and they could move up. So there is a risk that, yes, at the long end, mid to long end of the curve, we could see higher rates should a financial crisis show its ugly face. So we need to be ready for that. The other point is that the floating rate, it is a bit more flexible. Sort of the qualifying rate is a bit more flexible now. It is floating. But as I say, I think that one thing that has not been part of the language has been that stress test, that 1, 2, 3 point increase in interest rates, does correspond as well to or is equivalent to a move up in the unemployment rate of 3, 4, 5, maybe 6, maybe 10 percentage points. So sometimes we need to move away from just thinking about that stress test as we're just looking at a shock to rates. That shock to rates is equivalent to a shock to the unemployment rate on the way up, upwards, and we're already seeing that. So that shock could come and manifest itself in many different ways, when we need to be prepared for it, I guess. And we've learned, hopefully we've got some lessons learned from the U.S. experience, which had no stress testing, and we know the trouble they got into, over 2 decades ago. So anyhow, I just wanted to jump in.
Okay, we've got 10 minutes left. There, one of the questions one of our listeners asked is the same that was on our list for our last question, but there's one that doesn't pertain to that. I'll just quickly get this answered. It's from Steve when we were talking about vacancy rates north of 2%. Is that in the just in the GTA, or is that the whole country? I would say it's just the GTA.
Yeah, that's just the GTA. There's been some data released by some external groups, but for the country as a whole, we do get data on rents, and there you see rents off, in some cases 8-10%, and as Jenelle mentioned, for smaller purpose-built or condo rentals, could be as high as 15% drop in rent. So yeah, it's Toronto specific.
Okay, when you're talking about rents, that's rent prices or vacancy rates?
Rent prices, yeah. Vacancy rates, as I say, there's some evidence that they've gone north of 2%, 2.5%.
And that's GTA.
That's GTA.
Okay, thank you. Now Agnes has asked the question, which we decided was going to be the last thing we discussed, and that is, it's crystal ball time. And what do you see ahead in the market, short term and long term? Jenelle, we'll start with you.
Sorry. I don't know. This is against popular belief, but I don't see prices falling, if that's what most people are speculating. In the city, I don't know about the rest of the country, certainly, but when I think about what's happening in Toronto, I can see that the condo market may slow and has slowed, and maybe we'll see a bit of a price adjustment there, but I don't see any indication of prices falling in the city otherwise. I think things might change how we do things. Maybe they're not selling for $300,000 over asking anymore, and maybe it's taking 2 weeks to sell instead of 1 hour. But I don't see the prices dropping here.
Okay,
I
Steve.
might be wrong, but I'm just going to go out on a limb.
Steve, what do you think?
Yeah, it's a crazy market. I don't think maybe in the short term it might see a bit of a pause. I mean, traditionally when it gets cold, like it is now, and the weather gets colder in the winter months, the market slows for sure. And then as we get into the spring or pre-spring months like February, March, the market gets busier. I think as long as rates are low, people are going to see this as an opportunity to get into the market. Like Jenelle said earlier, the longer you wait, and if you try and time it, you're not going to do yourself any favors. So I think it's going to continue to be active.
Okay, Ted, what are your thoughts? You often have a bit of a contrarian's view to that, and you've got lots of research at your disposal. So what do you feel is going to happen short term and long term?
So short term, one of the reasons we've seen strength in the housing market, I talked about the labor market story, some benefiting more than others and keeping low-rise demand strong. We've talked about that. What we haven't talked about is that there's been some pent-up demand that's been building. And here's the other myth I want to dispel. I've been trying to dispel a few today. This pent-up demand didn't grow just in the second quarter because of the pandemic. The pent-up demand has been growing since 2018, 2019. I made mention earlier that stress testing pushed a few people to the sidelines. They've taken some more time to come up with a down payment. You know, 2 years later, interest rates are down. They've got more savings. They've jumped in. My estimate of pent-up demand has been completely exhausted by the end of September. So that means that moving forward, housing, whether it's sales or prices, need to converge closer to what fundamentals support. What the heck does fundamentals mean? What the labor market would support, what the affordability equation would support, what demographics would support. Well, sales in recent months have been running well above fundamentals, and so I expect two adjustments. The first one, a real deceleration in the year-over-year growth in sales and prices. That's the first adjustment. The second adjustment is an adjustment in price level. So we're talking about an outright price adjustment on the way down. I've just dusted off an old probability model that I've looked at in the past. It has about a 600 batting average. If you follow baseball, that's not a bad batting average in terms of predicting where prices are going. That model is now pointing to an increased likelihood of a price correction. And so in summary, in the short run, in the next couple of quarters, we're going to be seeing for the first time the true effect of COVID on the housing market. There's always a lead lag. So expect these two adjustments in the next few quarters. How much of a price drop? You know, this probability model suggests it could be meaningful, but that's one scenario. And you know, we've released a few scenarios out there, but I wouldn't rule out a house price adjustment. And we're already seeing some softness in the high density sector. So I would agree with Jenelle on that point. The question becomes how much of a drop. And you know, at the end of the day, the economy, demographics, affordability, they manifest themselves through the sales to new listings ratio. So if I was to track any metric right now, keep your eye on the sales to new listings ratio. It's sitting in and around 55 to 60% for the GTA. It's off from over 70% early this year. But if it drops below 40%, okay, 40% means that out of every 10 new listings flowing onto the market, if there's less than 4 sales, you're in a buyer's market where prices have no choice but to move lower. So keep your eye on that metric. If it drops below 40, yeah, prices are moving lower.
Excellent. Well, I think we're almost at the end of our session today. Thank you so much for participating, Steve, Ted, and Jenelle. I think we've got some valuable insight. I certainly have a lot of food for thought. Thanks so much.
Thanks, everyone.
Thank you.
Thank you.